นี่คือเรื่องราวของสองสุดยอดวิสัยทัศน์ชายผู้หนึ่งกำลังเดินทางไปพบเพื่อนของเขาในฐานะสถาบันการเงินแห่งแรกของประเทศไทยธนาคารไทยพาณิชย์หรือ SCB ได้เริ่มดูแลลูกค้าผู้มีความมั่งคั่งระดับสูงมานานกว่า100 ปีทำให้มั่นใจได้ว่า SCB เข้าใจความต้องการของลูกค้าคนไทยอย่างลึกซึ้งนี่คือเพื่อนของเขาจากดินแดนห่างไกลเมื่อ SCB ได้ผนึกกำลังกับ Julius Baer กลุ่มผู้นำธุรกิจบริหารความมั่งคั่งชั้นนำระดับโลกจากประเทศสวิตเซอร์แลนด์ซึ่งสั่งสมประสบการณ์ความรู้ความเข้าใจจนได้รับความไว้วางใจจากลูกค้าทั่วโลกมากว่า130 ปีวันนี้เรานำปรากฏการณ์ด้าน Wealth Management ระดับโลกมาสู่ประเทศไทยSCB Julius Baer คือสถาบันที่ให้บริการด้านที่ปรึกษาและการบริหารความมั่งคั่งเฉพาะบุคคลอย่างเต็มรูปแบบมากด้วยประสบการณ์และความเชี่ยวชาญจาก2 องค์กรพร้อมคำมั่นสัญญาที่จะดูแลลูกค้าผู้มีศักยภาพระดับสูงเช่นคุณให้อิสระสูงสุดในการเลือกลงทุนในสินทรัพย์ที่หลากหลายจากทั่วโลกแบบไร้พรมแดนด้วยมาตรฐานเดียวกับการบริการของ Julius Baerเพื่อสร้างโอกาสรับผลตอบแทนและบรรลุเป้าหมายทางการเงินในแบบของคุณได้อย่างยั่งยืนด้วยทีมผู้จัดการธุรกิจสัมพันธ์และผู้เชี่ยวชาญการลงทุนที่ผ่านการอบรมตามมาตรฐานการให้บริการจาก Julius Baer ผนวกความเข้าใจในความเป็นไทยทั้งด้านวัฒนธรรมและภาษาทำให้ทีมงานทุกคนพร้อมดูแลคุณในทุกมิติการลงทุนเพราะเราตระหนักถึงความต้องการที่ซับซ้อนและแตกต่างในการให้บริการเราจึงศึกษาและทำความเข้าใจลูกค้าในทุกรายละเอียด SCB Julius Baer จึงสามารถตอบโจทย์การลงทุนในแบบฉบับเฉพาะคุณ SCB Julius Baer คือคำมั่นสัญญาของเราที่มีต่อคุณและโอกาสในความสำเร็จของคุณเรานำเอาระบบบริหารความมั่งคั่งระดับโลกจาก Julius Baer มาสู่ประเทศไทยผสานความแข็งแกร่งของ SCB ในด้านความเข้าใจในความเป็นไทยอย่างลึกซึ้งนี่คือการรวมกันของ2 สุดยอดวิสัยทัศน์เพื่อส่งต่อความสำเร็จอันล้ำค่าไปสู่รุ่นต่อไปอย่างยั่งยืน SCB Julius Baer Your legacy our promise
Swadika. Good afternoon, ladies and gentlemen. On behalf of SCB Julius Baer, I'm delighted to welcome you all to SCB Julius Baer Market Outlook Mid-Year 2021 webinar. This is the first time that we have done webinar here in Bangkok, Thailand. So very excited. Why we are unable to meet up with you in person and have a chance to discuss the market view and trend of the world with you in person. Thanks to the technology, we managed to use this webinar to share with you our key investment ideas and investment thought as we enter the second half of 2021. While COVID-19 pandemic is still ongoing and why we are now talking about the inflation which may continue to rise, there's a lot of concern about the market volatilities. We still see many developed countries as well as the economies beginning to open up. And then we see many countries start to emerge from the crisis. We expect strong growth and see many investment opportunities although we also have a lot of concern and risk elements that we have to be anticipated of. We will share our views and how to best position your portfolio going ahead in the near future for both long-term and short-term positioning. It is my honor to have 2 distinguished guests as well as our key partners who will be a guest speaker in this webinar today. First of all, let me introduce Head of Research Asia Pacific Kun Mark Matthew, and also our Chief Investment Officer, Asia Pacific, Kun Bhaskar. At the same time, after we have no macro view and market trend, then we will have our Head of Investment Advisory and Solution from SCB Julius Baer, Kun Joseph Caceres, to talk about the solution and investment idea for your portfolio. During this time, I would like to express my sincere gratitude and appreciation to all of the customers that give trust to SCB Julius Baer. I wish your families the very best and hope that you all are stay safe, and we will see the quick recovery coming very soon. I believe that we will have a chance to meet up in person very soon to come. On behalf of our SCB Julius Baer and our team member, the relationship manager, investment advisor, also every staff member here, we are willing to work with you on either it's relating to the wealth management solution or actually be part of your family and life journey along the way. Please do let us know if you need any further assistance, information, or whatever that will be of your interest. Anyway, I don't want to take too much of everyone's time. I do really appreciate once again. Thank you very much. ขอบคุณค่ะ สวัสดีค่ะ
Good afternoon, ladies and gentlemen. Thank you for joining us here today on our webinar. I'm Joe Caceres, Head of Investment Advisory and Solutions here at SCB Julius Baer. We wish we could be seeing you under slightly different circumstances. We would love to be hosting you in a ballroom right now, sitting around having some nice conversations over a good meal. Unfortunately, the COVID situation as it stands now makes that a bit difficult. So we're bringing this to you virtually today, as Kun Lalipat said just previously. However, we don't want to let that stop us from having an interactive session with you. So we're going to use technology to our advantage in order to still manage to get your views and your dialogue joining us here in this webinar. So we're going to do two things. We're going to do some polling questions in order to understand your views, and we're also going to engage our guest speakers from Julius Baer in some question and answer period. And both areas you'll be able to submit your feedback. To begin with, we're going to start with some polling questions. It's important for us to understand the way that you feel, the way that you're thinking about markets, what type of concerns you have, how you are positioned, and what you're thinking about into the second half of 2021. So in order to do that, if you look on your computer screen on the right-hand side or on your mobile phone on the bottom, you will see a polling section. If you can please choose the polling tab so that you can vote along with us as we ask you these polling questions. So in order to make sure we're all familiar and comfortable with our device and able to vote in the polls, we'd like to start with a test question for the audience. So the test question is, what will be your first holiday destination once air travel opens up again? Is it somewhere nearby in Asia Pacific, for example? Perhaps Europe, that trip you've been meaning to take to Paris ever since COVID-19 hit. Could be the Americas, something like the US or Canada, or even South America for that matter. Perhaps something a little more exotic and distant, like a trip to Africa, or, like me, anywhere. It doesn't really matter at this point. I just miss my holidays. Please vote now. Okay, we'll wrap up our polling here and take a look at our results. And it looks like we have a pretty mixed bag. I guess nobody's going to Africa at this stage, but I hear that it's a beautiful place to visit and go on safari. Looks like Asia's at the top of the list, but a lot of people are eager to just simply be able to travel again. Okay, now that we're all familiar with the voting procedure for our devices, we're going to go ahead and ask a few more serious and relevant investment questions. Now, as you heard earlier, we have joining us today two of our esteemed partners from Julius Baer in Singapore. These gentlemen are listening in right now, and they will be able to respond to your concerns in this polling session. So let's start with the first question, and that is, what do you feel is the greatest risk to markets in the second half of 2021? We hear a lot these days, and we've been hit quite substantially with the next new wave of COVID in Asia. So is it COVID-19? Is it inflation? We hear a lot about that. We've seen a lot of talk on inflation in the news and affecting markets clearly. Could it perhaps be geopolitical tensions, for example, between the US and China or other large superpowers, or indeed something else? Please vote now. Okay, we'll wrap up our polling here, and not unexpectedly, we have a lot of concerns about inflation, and we're going to be discussing that here at a fair deal of length with you here during our investment presentation. Obviously, we'll also touch on COVID, where we see very different scenarios in Western countries versus some Asian countries. We'll talk about that and what that means for investments. Moving on to question number 2, regarding current market valuations, which of the following statements would best represent your view? We are in a major bubble, which is soon to burst. Things are a bit expensive, but I still believe the market has further room to go up. I'm not concerned about valuations at all. Or, especially since COVID-19, I'm not really sure I understand the market anymore. Please vote now. Okay, we'll wrap up our polling here. And it looks like the clear winner is being cautiously optimistic. Things might be a bit expensive, but they have further to go from here. I think a lot of us share the same view, and we will talk about that, but we'll also talk about whether or not we're in a bubble, what might be a catalyst for things to look better or worse from here. We'll address these concerns very shortly. Let's move to question number 3. Now, obviously, your view in question number 2 is going to have a fair bit of influence over your positioning for question number 3. But what asset class are you currently most overweight in your portfolio? Is it equities, corporate bonds, government debt, cash, or alternative investments? Please vote now. Okay, we'll wrap up polling here. I think looking at this, we may be missing what looked like a few other asset classes that have been voted, but it looks like at least over 70% are answering equities at this stage. And that's not surprising, given that the majority of us also believe that markets, whilst expensive, whilst we must be a bit cautious, they still have further to go. And so obviously equities make sense at this stage. And given that we expected this to probably be the case, the next question follows on from this one and poses what type of equities you're holding in your portfolio. So we've seen some rotation this year. Obviously, the IT, the tech, the growth names that were propelled through the COVID crisis have seen a bit less love as we've seen rotation into some of the cyclical names or some of the value names. So it's been a bit difficult if you've been trying to call the timing and rotation in the market. Nonetheless, we'll ask the question, what style of equities are you most likely to own in 2021? Growth stocks, value stocks, cyclicals, a combination of various styles, or actually, you're just not sure? Please vote now. Okay, we'll go ahead and wrap up the polling here. And it does look like the highest result here is in the combination of various styles. And of course, we also would agree with you. The question is why and how we can go about this, and we will address that later in the presentation. So that concludes the polling questions. We're going to move into the next portion of the presentation where we will hear from our guests at Julius Baer. During the presentation, if you would like to ask questions, you can go to the same section where you saw your polling tab, and indeed you can click on Q&A on that tab. You're free to enter your question at any time during the presentation. We will have those questions ready for our guest speakers once we conclude the presentation, and we will engage in a bit of Q&A with them. I'll come back up here onto stage and we will ask your questions to our guests today. So with that, I would like to introduce our guests joining us from Singapore in Bank Julius Baer. We have with us Bhaskar, who is our Chief Investment Officer Asia Pacific for Julius Baer, as well as Mark, our Head of Research Asia Pacific for Julius Baer. They've been listening in. They understand the temperature in the room. They understand what the audience is saying in the polling, and they will address your concerns as well as give our overall view on the market and portfolio positioning as we move ahead into the second half of 2021. With that, I'll pass over to Mark and Bhaskar. Gentlemen.
Thank you, Joe. Good morning to all. Good afternoon to all. I'm Bhaskar Lakshminarayan, Chief Investment Officer in Asia at Bank Julius Baer. And as Joe told you, I'm joined by Mark Matthews, our Head of Research in Asia. Hello, Mark.
Hello, Bhaskar, and Swadikap Tan Pumikit Tuk Tan.
Thank you. In the next 45 minutes, Mark and I will present Julius Baer's mid-year market outlook and take questions at the end of it, as Joe has pointed out to you. And to get things rolling, let's start where we normally do, which is with our asset allocation. This is what we recommend for investors who we call for a balanced portfolio or the balanced investor, meaning this is not very aggressive, not very conservative. It's bang in the middle of the risk spectrum. And as you can see here, and as you also voted appropriately, even for the balanced investor, we think the largest part of the portfolio should be in equities. You can see 53% is represented by equities here. And there are a few reasons for the same. We're going to be talking about that through the call. Now, second, we do see opportunities in bonds, which is why we still have a healthy 36% allocation to them. But what we can tell you for sure is the opportunity set is not nearly as many as we see in stocks. We have a modest allocation to alternates at this point in time and treat cash as purely opportunistic, meaning we are looking for the right ideas to deploy the same. There is very little merit in owning cash as a long-term strategy in any portfolio allocation. Okay. To get, again, today's events rolling, we're going to give you a picture of how to look at markets. It's always easier to think about something if you group them into key concepts and separate parts, and that's what we've done here. There are 4 pillars that we've broken them into. On the 2 on the left are what we call as cyclical stories. So starting with the big picture on the far left, basically what we want to talk is about the strong economic recovery the world is seeing, led by the US. This year, the US will grow by its fastest rate in 36 years. What this also means is, as you again have rightly pointed out in the polling questions, inflation is the hot topic of markets today. These 2 factors would also translate, growth and inflation, would translate into higher volatility and sector rotation in markets. Neither should preclude investors from making positive returns. Our conclusions are listed at the bottom of that column, and you can see that the key recommendations from a big picture perspective is that you need to own technology, healthcare, value stocks, as well as China, which has been our long-term story that we've talked about. But we want to add a new idea in terms of country, which is Indian stocks. And we continue to reiterate our preference for Asian high-yield bonds too. Now, rising consumption is the second column. It's also the cyclical part of the story that I talked about. Over half of all Americans have now been vaccinated, and they're opening up the economy, which is why it's so strong. But they also had this incredible move by the Federal Reserve in terms of asset purchases. To put it in perspective, global financial crisis, the Fed bought $1 trillion of securities. Since February of last year, they bought $4 trillion. It's huge. And on top of that, as against which didn't exist in the time of the global financial crisis, you now have a fiscal stimulus program, which is completely unprecedented. Adding all of these means that you get a new set of ideas at the bottom of that column, which is consumer cyclicals, US small caps, which are very, very strong ideas for the immediate future. The next column is what we call sustainable investing. These are not cyclical elements, these are structural. Investing in companies that are caring of society and the environment may sound like a recipe for lower profits, but it's just the opposite now, in part because of what technology has done. Just as Kunpam initially said, we are able to have this webinar because of technology. Technology has clearly made some of these very, very profitable. For example, the cheapest energy in the world today is solar energy. And in part because the companies that are good to their customers, staff, and society at large are generally better run companies, and so they make for a better investment case. That leads us to the investment themes there, which are specifically focused for us on sustainable food and future mobility. Then the last pillar, but not the least, is adaptive companies. These are companies that have a track record of outperforming in times of change. The one that we're going through is the digital revolution. And this takes us to the key ideas there, which is digital health, cybersecurity, cloud computing, artificial intelligence, all very, very important places to be invested in. And these are things again, we will answer questions, and you'll be able to ask us more questions on the same, and we'll be able to answer them at the end of the session. But Mark, while we did get that polling question absolutely right in terms of saying that Corona is not, or COVID is not the number one risk, it's still good to know about this topic that we've discussed ad nauseum. Where do we really stand on coronavirus?
Bhaskar, the answer is that some parts of the world are good and some parts of the world are bad, but even for those parts that are bad, there's light at the end of the tunnel because the vaccines really do work. And we can see their efficacy in this chart here. A few of them don't work quite as well. They'll be improved or just quietly dropped over time. In America, it's mostly Pfizer and Moderna, the ones at the top right, and they reduce symptomatic COVID by 95%. Overall infection goes down by 90% if you've been vaccinated. So that's amazing protection. 135 million people have been fully vaccinated in the United States. Another 35 million have received one jab. That far exceeds the 34 million who officially got COVID. And so look what's happening now. On the top left, you can see confirmed cases are down over 90% from their peak. They're at their lowest level ever. And then on the right, for every 100 tests being done, just 2% are coming back positive. And on the bottom left, hospitalizations at their lowest level. On the bottom right, daily deaths have collapsed too. You watch television, you'll notice most people in America aren't wearing masks anymore. There's only 4 states that require you to wear a mask indoors. There still hasn't been another big wave there. Now, please understand, I'm not suggesting people shouldn't wear masks or practice social distancing anymore, because there's 2 big differences between the United States and some other parts of the world, including our part of the world. And the first is that so many people in America already got COVID. I showed you that chart, 34 million. It could be as much as 7 times higher than that. They have quite a lot of natural immunity there already. And most countries here in Asia, because we avoided the epidemic last year, we don't have that kind of natural immunity. But there's something else that's different. Canada and the US are the blue lines, European countries are the brown lines, and the countries in our part of the world are the purple ones. And these are vaccination rates. So in the countries represented by the purple lines, you can see that they're very, very low. That's us in Asia, unfortunately. Just to compare 2 countries that are in many ways similar, Australia, only 16 doses have been administered for every 100 people, 16. In Canada, they've done 60 for every 100 people, 60. And one problem is people in these countries here in Asia, and I must say including Australia, have been conditioned to think that 0 is the only acceptable number. Now, just as cases are going down in places like Germany and Canada, we can see they're rising in places like Thailand and Malaysia. And because these are coming in from overseas, these new cases, many people in Asia are saying, keep the borders shut. Well, maybe in China and Australia that could work. They could probably give up their international tourism, their business travel, their international students. They'd probably still survive. But Thailand, Malaysia, Hong Kong, actually quite a few countries in Asia, they're just not economies that are structured to be closed to the rest of the world for very long. And every day that goes by that they stay closed, they're losing to the parts of the world that are opening up. We have a mixed scenario here in Southeast Asia. Mobility is good in Indonesia, higher even than it was before COVID, amazingly. And so private domestic demand is picking up quite nicely there. For whatever strange reason, Indonesia didn't get hit by the second wave the way that Thailand and Malaysia did. Thailand, interestingly, the mobility's been turning around, and in general, the vaccination rates are accelerating. I think people were a bit skeptical of the vaccines in the beginning because they were worried about the quality control. Astra, for example, is going to be made in Thailand. But the more people who do go get vaccinated, the more others will feel comfortable following them. I know that's what we've observed here in Singapore. What these countries do have to tie themselves over is some very strong exports. So what we can see here is the exports in Thailand. They're doing very well across the board. And countries like Thailand also are getting some, are very competitive compared to China now. In fact, their labor in many cases and their industrial land is cheaper than China's. So that's helping balance out the fall from tourism and retail sales. And we think the baht should be stable because the current account in Thailand will still be a surplus. But for sure, the second COVID wave is going to have an impact. So Thai GDP growth this year, instead of 3%, will probably be closer to about 1.5 or 2.5 instead. Let me show you a chart that sums things up. The share prices of all the listed airlines in the world divided by the world stock market. And the market tends to look forward about 6 to 12 months. So at least what the market is telling us is it doesn't think we're going back to the way we were very quickly. The message is the world's reopening. It's reopening rather slowly. Maybe the better way to say it is some parts of the world are reopening, but many other parts aren't. For example, the Transportation Security Administration, the people who look at your carry-on bags when you're going through the airport in the United States, they're getting about 2 million passengers a day in American airports, up from about 200,000 during the epidemic. So they're moving back to the average of 2019, which was 2.5 million passengers a day. Just to put that in perspective, only about 600,000 people have gone through Singapore's Changi Airport so far this year, compared to 68 million who went through the airport in 2019. But if I was to leave COVID on an optimistic note, the vaccines offer a huge level of protection. So if there's good vaccine coverage worldwide, COVID's transmission rate will become so low, it won't be able to find new hosts at a fast enough rate to sustain itself. And then we'd have a situation like measles, where there's occasionally flare-ups, maybe even like polio, where we can get rid of it completely. The medical science has never been so dedicated to eradicating a disease as it is for this one, so the vaccines and the therapeutics are going to get even better. Now, Bhaskar, let me ask you, for the countries like the United States, which are putting COVID behind them, it is definitely in the rearview mirror. What is the market focusing on now?
Absolutely, Mark. I mean, I'm going to answer that in a minute, but I always, every single time that we talk about this particular slide, it just amazes me the fact that the US is almost back to its 2019 levels. And if you were to take the statistics in China, it's very similar.
Oh, yes,
so actually the local mobility in these places are completely back to normal.
It is.
And therefore, again, the story of being domestic in these places is very important. But before we get there, let me answer what Mark just asked me. And as you all answered correctly to begin with, when the polling question was asked, inflation has now become the number one risk. Well, Mark, here, this is a study by Bank of America, okay? And the number one risk is now, as you can see, is inflation. But from April last year, all the way until February of this year, it was still COVID. It's only since then, but what's happened is you can also see how quickly the virus is now becoming the fourth biggest risk. It's not even second, right? You now have inflation as number one, Fed reducing its bond buying as number two, asset bubbles as number three, and then comes the virus, right? COVID did, however, leave an important legacy in markets. And one of the reasons that inflation is now the number one risk is because of that situation. And what was that? It was basically how quickly the governments came in to help. We remember we talked about the stimulus program. This is how that stimulus program really looks. The fiscal stimulus in the US, which is that purple line that you see there, which is typically the other benefits that typically the government does on top of medical and social security. And you can see what happened between last year, March or April to now. It's just skyrocketed. And that's really what unprecedented looks like. The government has given benefits in a very significant manner, and all of them have immediate effect. And what does that really mean is this is what happens with that immediate effect. The people received these grants, and then they went and spent it. They spent it on food, retail. It was sort of immediate consumption, which is also why when you have such immediate demand on many things and supply does not catch up or keep up with that response, then you have an inflationary environment that comes up, right? Now we can talk about how it's going to be, is it sustainable or not, but what it does is it just doesn't become a local US phenomena, because as we know, supply is no more just a domestic situation. When people consume, it's a global thing that gets impacted. And this is what happened, therefore, in China. China is still the factory of the world when it comes to consumer products. And factory gate prices in China are up 17% in the past 12 months. I think we printed another high as we speak. And we can see that this, again, is why inflation is becoming the biggest concern for markets. It's also interesting at this point in time to look at what is it that correlates really to inflation, right? And if you look at that from various assets, obviously, the thing that inflation does not work well at all is as you come to the bottom of the screen, is government bonds. Bonds and inflation are like chalk and cheese, right? And it's not really stocks either. Those stocks are at least positively correlated because in the initial phase of inflation, you think growth is coming back. Therefore, at least there is some positive correlation. But where it really shines is things that you like to own, that you can actually own and touch, like art, which is why auctions are going through the roof, cars, collectibles, and of course, one other big thing, which is real estate, right? Very key. But on top of real estate is really the key winner in this argument, which is commodities, because as consumption takes off, there's a greater need for commodities. That's where you see the biggest impact. But it's also therefore important for everybody here and for us to talk about commodities. Mark, could you share your views on what we think about commodities?
I most certainly will, Bhaskar. Well, those Chinese factory gate prices that you showed us earlier, that red line with the Chinese consumer products going up, was it 17%?
Yes, 17.
Those are all made out of commodities. And so smartphones, for example, are made out of things like copper and aluminum and plastic and rubber and glass and rare earth metals. And anyway, when you put all those into an index, this is what you get. And their prices have doubled from where they were last year. And you can also see that they would have to double again to get to their previous peak. You showed us as well the correlation between assets and inflation and how real estate correlates very well. So I want to also show you that there's a reason why real estate is so rising so quickly here. You can see that and by the way, real estate's about a third of the inflation basket in the United States. You can see when COVID happened, they didn't go down, the real estate prices. In fact, they just started to really take off. They're up 13% from where they were last year. And one reason is because the interest rates are low. We think they're going to stay low for quite some time. Another reason is that inventories are very low in America right now. There's less than 500,000 homes for sale in the United States today. That's about a fifth of the average over the last 40 years. Believe it or not, in the United States today, Bhaskar, there's now more real estate agents than there are homes for sale. And what happened was, I think, two things. The first is when COVID happened last year, most people thought prices were going to go down. So the people who had their homes for sale, they took them off the market. And then another thing is the millennials, who are now the largest part of the population in America. Took them a long time to build up enough capital to buy a home because those poor young people got hit by one crisis after another. But increasingly, they have the capital and they're buying because they want to start families and own their own home. So every home in America today is on average getting over 5 offers. And half of the homes listed for sale in April were sold in less than a week. And one poll found that most buyers are bidding on homes they've never even seen in person. And what all that means is that they need more homes. And that means demand for lumber, concrete, stone, copper, brick, everything that goes into a home. So you'd think, Bhaskar, that should mean there's going to be lots and lots of inflation, which you have been talking about, what I've been talking about. And now I just want to say that we don't think so. And I want to tell the ladies and gentlemen listening to us why we don't think there's going to be a lot of inflation. The first thing that I would like to show people is the last big commodities bull market that happened in the 2000s. Here it is. The chart on the top is commodity prices. They went up 5 times in less than 10 years. I think it was around from 1998 to 2008. But look at the chart on the bottom. That's the core personal consumption expenditure deflator, the Fed's favorite measure of inflation. And you can see, even though commodity prices rose 5 times, much more than they have today, inflation wasn't bad. And let's not forget something else. The largest buyer of commodities is not the United States, it's China. China buys over half of many of the important commodities like iron ore, like copper. Reuters calls China COVID's first in, first out economy. That means it was the first economy to get hit with COVID. It was also the first to recover long before others. So its government started taking back the liquidity it gave to help the economy through the tough times last year. Chinese money supply growth is the brown line in the chart on the left. And if you look closely, it was growing at 15% back in January. Today, it's growing at less than half that rate. It's growing around 6%. And that brown line has also been pushed forward by 6 months to show it has a good history of being a leading indicator for, guess what? Commodity prices. They're the blue line. So that chart tells us commodity prices should stop going up, actually should start going down. And the chart on the right is the same story. The brown line is Chinese copper imports pushed forward by 6 months. The blue line is the copper price. Same story. Then there's the fiscal stimulus in the United States that Bhaskar talked about, and he showed us that amazing chart of government stimulus as a percent of GDP. And what's driven a lot of the retail spending has been this government stimulus. It's the dark blue bar on the left, the American Rescue Plan. But you'll also notice it runs out next year. And it's getting replaced by the green parts, the American Jobs Plan, the American Family Plan. If you add them up, they're a lot of money. They're $6 trillion. But there's a few things about them that are different. The first is they're not spread over 2 or 3 years. They're spread over 8 to 10 years. They're investments in things like education and healthcare, where the feed through into inflation is much less pronounced than sending a check to somebody in the mail. And the government isn't going to be able to finance these through borrowing like it did the American Rescue Plan. It's going to have to raise taxes if it wants to do this. That's the orange bars. So the net impact of the stimulus, the purple diamonds, look how they're going to go down a lot in the years ahead. But also, it's rare you find a politician who likes being identified with higher taxes, and there's a congressional election coming up next year. So this future stimulus is almost certainly going to be watered down a lot. Let me give you one last reason why we don't think inflation is going to be an issue. Look at the top right of this chart. Last year, American companies increased their spending on technology by 30%, and that was the biggest increase ever. And the effects of this will be profoundly deflationary, as technological investment always is. Let me just give you an example what Amazon has planned for the next 5 years. They're getting into pharmacies. They're getting into insurance, small and medium-sized enterprise business lending. They're going to be delivering things, not just the things we buy from them. They'll deliver anybody's thing. So they'll be competing with DHL and FedEx. Home appliances all linked together through Alexa, their virtual assistant. Do-it-yourself tools, home and garden. The list goes on, but I think you get my point. The American economy is in the middle of a massive digital transformation that can't be stopped. It cannot be stopped, and what it does is it pushes down prices, because all those things I told you, Amazon can do much cheaper than brick and mortar companies. And so it can sell for cheaper too. And so can the many other companies that are online or moving online. So is inflation really a risk? Well, I'll show you what the real world is thinking. Small businesses are the canaries in the coal mine when it comes to the economy. In America in particular, they're in very cyclical sectors tied to the ups and downs of the economy. They're operating primarily in the local economy. They don't really sell a lot of things overseas. So the Small Business Association's monthly survey shows that only 6% of small businesses say that inflation is the single most important problem. That's much less than it was back in the 80s. It was 20%. If you look over on the left, it was as high as 40% in the 1970s. Well, Bhaskar, we've talked about COVID, how it's in the rearview mirror in America. We've talked about how, yes, inflation's an issue now. We don't think it's going to be an issue for next year. Could you tell us, please, how that should feed through into how we invest our money?
Sure, Mark. And, as I keep pointing out, the arguments that you make for why inflation is transitory rather than otherwise, is very compelling. And we could also possibly say one key takeaway from this is technology is not done, and as long as the technology penetration continues, you're going to have this deflationary effect on the overall world. It's not going to change that quickly. But let's turning to assets. Let's see how they've done. And you can see this is the last decade of various assets. We've got right from Bitcoin all the way to commodities with the stocks and bonds in there. And you can see in general, it's more teal. It's supposed to be green, but what it tells you, it's all positive. It's generally, in fact, if you look at the percentage of asset classes that are positive, it's quite high as well throughout, except for 2018. Literally every other year was quite high. Now that means it's been a good set of numbers, but they're just not good. They're extraordinarily good in certain cases. The one that stands out is Bitcoin at the top. And here we would like to say a few things. First, it doesn't really have an asset to peg itself to give it value. While stocks, and it's the how you value stocks. With bonds, it's cash flows. With property, it's location. But with Bitcoin, has none of those. So the demand is driven by market sentiment, and that can swing pretty widely as we are seeing right now. But if you even look back in the last 10, 12 years of its existence, it's lost more than 75% of its value on 3 separate occasions. That's happened once with the stock market, that too during the Great Depression, right? Another thing we can say is it's not a diversifier. Every single time, or at least 4 occasions in the past 5 years when equities fell by 10%, on 3 of those occasions it went down by even more, right? So it doesn't diversify your risk. And then on top of that, there is the environmental issue we talk about when it comes to Bitcoins. As the price has gone up, it's made it easier or more profitable to mine these with less efficient equipment. And this clearly is costing some amount of usage with fossil fuel energy. What we do know is this, that over 2/3 of all cryptocurrency mining is done in China, where coal is around 60% of the energy mix. So this can't be too good. So while Bitcoin and other so-called dirty coins could be replaced by different coins in the future, the government wants to be more and more involved in this. So it's another risk. It's true, crypto as a concept is here to stay. Okay, we are at the beginning of the digitization of finance, and potential move of multiple things to things like blockchain is a reality. So we have to account for this. And we know that something like this has the potential to change the world, as internet did back in the 1990s. But we also know that if, for example, the architecture around them, they're very reminiscent of the dot-com boom. But we also know after the dot-com boom came the dot-com bust. Many companies did not survive. So how do you know whether the ones that you're owning today are the Netscapes and Yahoos, while it should be the Amazons and Googles, right? So it's difficult to answer this at this point in time. Only time will tell. We'll keep revisiting this topic over and over again, right? As we get more clarity, there is better ways to invest in it. But for now, let's return to the more traditional financial assets, namely stocks and bonds. And in this table, let me start with the bonds first. If you see, there is basically the long duration bonds, treasuries, high yield bonds, investment grade, emerging markets. And if you were to see all of that, none of them have great return profile. Almost all of them are negative. The best is actually high yield bonds that are flat. And the reason for this is actually quite clear, which is if you were to look at what happened with the 10-year treasuries, right? 10-year treasuries were as high as 5% in 2006. They made a great investment case. Since then, we've seen it go all the way down to 0.5 last year. And now that the economy is getting better, so there's no reason for it to go back there. And you can see that even our own forecast for next year is closer to 2.1%, which is significantly higher from where we are today, closer to 1.6. So bonds are generally not going to like that. At the same time, it's important to point out that the 10-year is still negative on real rates, right? Which means inflation expectations are higher, so nominal rates minus inflation is negative. This is one more reason that we believe that inflation is going to trend down rather than rates go up, right? This is why there are parts of the bond market, but which are attractive, and we advocate a 36% balanced position in the portfolio. The ones we like the most are high-yielding bonds. So like we said, there is not too many choices, but the choices are clear. Their performance correlates more closely to stock market, and that is the case with not the case with investment grade and government bonds, because they tend to be more risk-free. It's not inclined to growth, and when growth happens, you have high yield doing better. Why is that? Because the economy is stronger, the ability to pay back the bond goes up, risk of defaults go down. And so what happens is rating agencies start upgrading these credits. And when you upgrade them, you get a significant kicker in the performance, right? And even among the high yield space, why we like the US high yield as well, we actually want to highlight the importance of owning Asian high yield, as we pointed out right in the beginning, which is this. The blue line that you see right up there is the Asian high yield component, right? Yielding you somewhere around 8% odd. And you can see that the yellow line is basically what the US is. And it comes back to what you talked about earlier, Mark, in terms of the vaccinations, right? The low vaccination rates, ironically, they create this environment where in Asia, the governments have to keep their borders closed, economic recovery is delayed, but let's be clear, it's only delayed, right? It's that same recovery process that you've seen in the US now is going to happen in Asia as well. And this presents an opportunity set. For one, we are likely to see a more accommodative stance from policymakers. Perception that Asia is more risky is going to lead to this sort of spread that is widened, is its widest, right? And in general, you can see that Asian yields, therefore, are a bit higher, as you can see in this case, and the spreads are widened to the most. Even accounting for some further widening, they make a great investment case for anybody who wants to hold it to maturity, because these are generally shorter papers, so that's great, right? So that's the key idea that we have for you on fixed income. Turning to stocks. Now, I always say there is one important slide. While I don't want to call this the most important slide in this pack, what I do want to say is the message that this slide brings. The bull market continues. To me, this is the key message. As most of you, again, have answered in the question saying equities is your primary preference, that is the way it should be. Trying to guess the end of a bull cycle by staying out is a very, very painful experience. So first stay invested, and then one can debate about the merits of the cycle, valuations, liquidity, everything else we're actually asked in those questions, right? Just take the example of Joe Biden, for example. We've talked so much about this. He surprised the political analysts who followed his career over 40 years. He's been a centrist on most issues, conservative on a few, and he's now completely swung to the left. And still, the market seems to actually like what he's doing. And this is what a bull market can do. It can ignore many other things and just keep going up, right? In fact, if you compare his return, which is what this slide is about, in the 130 days, he has been the best president in a long time. Only Lyndon Johnson, William Taft, and Franklin Roosevelt had better performance, and you got to go way, way back to get that kind of return. Right? So markets, again, to talk a little bit more on fundamentals and liquidity, which are the two key guiding factors for markets, let's look at the forward consensus numbers, which are the real, the way earnings are going to pan out. The S&P 500 earnings this shows you from recession back to the growth. The green line, the blue line, and the red line are the past ones. In those ones, it took around 170 weeks, that's 3 years, for earnings to get back to where they were before the recession started. But this one, the first one, the black one, it's just taken 60 weeks, a little over a year. The resurgence in earnings has been completely off the charts and surprised almost anybody in terms of who are doing, or any of the analysts, right? The same thing when you look at, again, in terms of revenues, the fundamentals are very good, and you can see that the earnings for the first quarter was 48% higher, the highest surprise factor ever recorded in modern markets that we know about. And this quarter, it's likely to be closer to 60%. Again, something to celebrate about. We'll keep markets buoyant. But even if we were to go to the third and the fourth quarter, they trend down, but they trend down to 20% YOY growth, which is non-pedestrian, nothing to sneeze at. So chances are the markets are going to stay fairly supported by these data points, right? Let's talk about the liquidity element, and this is the Fed balance sheet. We've talked much about what happens in terms of how the Fed is supported. And we also know that there is no near-term risk of rates being increased, right? And the markets like that. They like the high liquidity. They like the fact that rates are going to be low. Let's talk about the fact that, what pre-GFC or the global financial crisis was really an academia topic, which was quantitative easing. This is the amount that central banks buy publicly traded securities. We talked about how at that point in time, they bought, we can see, the money that was actually been flowing in. That's basically the yellow line that you see there, right? You can see how it spiked all the way from 2020 to now. And we said this at the beginning where we said about in the GFC, the federal government bought, or the Fed bought about 1 billion or 1 trillion of securities. Now, since last year, they bought 4 trillion. This is huge. Now, of course, after such a huge program, there have to be talks of reducing this. We are on this camp. We do think that quantitative tightening of some form will have to happen. So tapering, whatever you want to call it as, right? Is that necessarily good news or bad news? Of course, a lot of people, market people tend to panic by saying, oh, there's tapering. But the good news is this. If you were to look at the left side, the Fed did gradually taper through 2018 and 2019. You can see it dip. The markets initially fell, but then realized this was actually good because economies were recovering, okay? And then the stock markets went up 29%. That's part and parcel of investing in equities. You're going to get some volatility, but it's going to be nothing compared to what we talked about Bitcoin. Since the end of global financial crisis, actually 12 years ago, there's been 28 times that the S&P fell 5% or more. But if you're held through that, the market returned to you 480%. That is the thing about staying invested in a bull market. Now, if you watch the stock market closely, you may know that there's been a roaring debate about, again, this is a question we asked you, growth or value stocks. And as you rightly pointed out, owning both is the right answer, right? The one point that I would talk about, which used to be growth and now seems more like value, is the healthcare sector, right? And this belongs to the drug companies, which are large, insurance companies in the United States, and more recently, biotech companies. But for the group as a whole, we can see that the relative valuation of market is much lower than any time it's been in the past 20 years. The one other time it was cheaper was during the GFC, the global financial crisis. There are plenty of reasons otherwise, even apart from the cheapness, which is great argument in itself, to own this. One, longevity, a key that we've been highlighting as our next gen opportunity, is a great reason for spend or bigger and bigger spend on healthcare. This is supportive of the sector. The second thing is post-COVID, people have become more health conscious. This again is going to lead to a bigger spend. But as terrible as a tragedy that COVID has been, it does have certain blessings in disguise. We are at the inflection point in a way when we look at medicine and healthcare. Mark, you just pointed out, imagine a world without flu, without AIDS, without cancer, And that's what happened with the Spanish flu, by the way. The scientists were trying to find a cure, mistakenly thought it was bacterial, and ended up discovering penicillin and therefore antibiotics. Okay, they ended up being a big support for curing various other things through the century. Then we think about growth. Well, most of the time when we say growth, what comes to your mind is technology. And we do like technology stocks, and we do think this is a part of, we are in the digitization world. Technology has not run its course, and you got to own them for the longer term perspective. So not owning them would be like not owning car companies or oil companies 100 years ago. And those were the building blocks of that economy. The building blocks of this is technology companies. The one other idea that I want to leave you with is on small caps. Small caps is a hybrid between growth and value. They have three great characteristics. One, they are small and therefore not too many people cover them. Therefore, they tend to be a bit cheaper. The second is small companies tend to operate in businesses that are mostly tied to the ups and downs of the economy, which is very, very, very key. And in the United States, they operate in local economy, not overseas. So they're a purer play in the US. The chart on the left shows the responsiveness of earnings. You can see they're 3 times more responsive as compared to larger caps. And on the right, you can see the GDP, as we mentioned before, is the strongest in the US, a 36-year high. Now, as a tactical investment over the next 12 months, this makes a great case. You've got to own US small caps in your portfolio. But enough said about the US, Mark. Can you tell us how things are looking in Asia, and also talk a little bit about our key themes on sustainable investment and adaptive companies?
I can, Bhaskar, and thank you. So what we're looking at here is the US stock market and the Chinese stock market over the last year and a half. China is the orange line, and you can see it was a big outperformer right up until February. Then it fell 15% quite suddenly in March. And what we can say is this decline has been completely self-induced because China exited the COVID epidemic well before the rest of the world, so it had a recovery last year. The recovery the West is experiencing right now. And so what they're doing right now, the Chinese, is they're fixing the roof while the sun is shining. And what I mean by that is, if you recall the chart I showed you earlier about money supply and commodities, Chinese money supply growth was 15% in January, down to 6% now. As a result, the loan growth is the slowest it's been since 2002. So there's less liquidity. And that's certainly a contributing factor to the correction that we've had in the market there. The other thing is a regulatory crackdown on the so-called new economy companies that are the primary engine for the digitalization of the economy anywhere in the world. China has, as you know, many, many of them. It doesn't mean, though, that these internet giants are not going to have any more growth. And the main reason for that is we talked about the digitalization of the American economy. Well, the Chinese economy is digitalizing too. Just for example, in the consumer retail sector, online penetration 2 years ago was about 25%. Well, by 2024, analysts estimate it's going to be 40%. Imagine that, from 25 to 40 in just the span of 4 years. And there's similar trajectories for groceries and food, travel, entertainment, real estate sales, education, healthcare. They're all going to become more digitalized. The government likes this, it wants this, but it doesn't want all the goodies going to a handful of billionaires, and then the moms and pops get squeezed. So the internet giants are going to have to share. And the government also doesn't want a whole generation of young people leading miserable rat race type lifestyles because they have to abide by the 996 schedule. In case you don't know, 9 in the morning to 9 in the evening, 6 days a week is 996. That's the official work schedule for many of the Chinese internet companies. But on the other hand, China can't afford not to digitalize when it's clear that technology, as Bhaskar said, is as important as oil or vehicles were 100 years ago. It's the key criteria that will determine a country's power in this century. So the government will step in to help society from time to time to balance things out, and the internet giants are going to have to share more money and time with their employees, their merchant partners, with society at large. But there's still a lot of growth left for them. When I told you earlier that all of those sectors of the economy will be digitalizing very rapidly. So with their share prices down about 20-30% from where they were in February, we consider quite a few of these Chinese internet giants even cheap, which they haven't been for many, many years. So there are opportunities for the next year, for the next 5 years. They're really, the next 5 years, there are things like Bhaskar said earlier, technology should be core part of your portfolio. Then to round things off, Bhaskar, you mentioned in the beginning that India is one of our new recommendations, and we took it to an overweight in February just before this terrible second wave of COVID happened there, the worst that any country has experienced so far. It's a humanitarian disaster, there's no doubt about it, but it won't impact the economy very much. So instead of growing at 10.5% this year, it might grow at 9.5% instead. We're still looking at we're still looking at earnings growth of over 20% in India this year and next year. So even if these COVID cases underrepresent the actual numbers, the official numbers underrepresent the actual numbers like they do everywhere in the world, what we can say looking at this trend is it is reflective of what's happening on the ground. And like other countries in Asia, India was tardy with the vaccines. But the second wave has really given a new impetus to the vaccine drive. Remember the chart on vaccine efficacy we showed you at the beginning. And what it showed that I found the most surprising, Bhaskar, was that Russia's Sputnik vaccine has a efficacy almost as high as Pfizer and Moderna. Well, Sputnik imports to India will be about 50 million doses this month, and that will take daily doses from 2 to 4 million. And then domestically produced Sputnik will start in September, And that's going to take the daily doses in India to 5 million. So just based on that, more than 60% of the population will have gotten 2 doses by the end of this year. And I would guess that because of this terrible tragedy, a lot more of the global surplus is going to get redirected to India too. It's difficult to believe, but the Indian rupee, the Indian stock market, are actually higher than before this terrible thing happened. And I just think it shows the firmness of this market, dare I say the unbreakableness of it. And there's quite a few reasons we like it, but in the interest of time, I'll just give you one. India's working age population is the brown bar here, and it surpassed the dependent population in size in 2018. What we can see is that demographers estimate this situation where there's going to be more people working than people depending on them. It will remain the case until around the year 2055. Now, when we look at other countries, which you can see on this chart, and identify the years when they started a similar kind of golden period in their demographic profile, we see something very interesting. Japan's at the top. Its working age population became larger than its dependent age population in 1964. Korea, the same thing happened in 1987. China, it happened in 1994. Now just take yourself back in time. Japan in 1964, Korea in 1987, China in 1994. The next 10 years for all of those countries were generally ones of great prosperity. Then the last thing we'd like to talk about is sustainable investing and adaptive companies. Sustainable investing is going to be one of the major themes of this decade, no matter what happens to interest rates or politics or anything else. And basically, there's a recognition that the targets we've been using, things like GDP growth for politicians, profit growth for CEOs, just on their own, they have actually sometimes encouraged bad behavior that can hurt the economy, hurt society, hurt the environment. So as the recognition of this and new targets are being set, so-called ESG, environment, social governance targets. One of them is to change our energy sources, because you can see, particularly here in Asia, looking at this chart, that most of the sources we're using now create greenhouse gases that concentrate in the atmosphere. They trap the heat down below. They make the world's temperature rise. So most of the energy in Asia you can see is the bad kind, coal, oil, gas, the red parts in the chart. We've got to move away from that to the cleaner fuels, which are the green ones. So the chart on the left here is the world's energy mix last year. Once again, you can see it's the kind, most of it, that damages the environment. And the targets that have been agreed to by the 197 countries that signed the Paris Agreement are the chart on the right. The most aggressive of them is the NZE 2050, net zero emissions by 2050, carbon neutrality. You're not producing greenhouse gases at all on a net basis. And many countries have committed to this target. Britain, France, Japan, Korea, China has committed to getting there by 2060, 10 years later, but still, that's coming up. So to do that is going to require a huge transition to renewable energy, and that's something that you can also invest in. No matter what your own personal opinions might be about this, you might not believe in it. The fact is, the idea is not going away. It's going to get bigger and bigger. Because young people do believe it, and they're going to be taking over politics and business every year that goes by. In fact, we can see here in 5 years, the vertical line in the middle shows us millennials and zillennials, people aged 40 and below, will be a larger part of the voting population in developed countries than people 41 and older. So as simple as it sounds, avoiding it is impossible. This is reality. We should invest along these lines, knowing that the companies that don't meet the ESG criteria will be increasingly ostracized by government, society, and investors. And as for adaptive companies, well, these are companies that have a track record of outperforming in good times, bad times, but also times of great change, like the times we're living through now with the digitalization of the economy. And there's bound to be companies that can't adapt, just like the companies that made whale oil or buggy whips were replaced by petroleum and cars when those came along. A lot of companies do understand they need to be adaptive if they're going to survive. Boston Consulting found 75% of companies they surveyed placed innovation as one of their top 3 priorities. So one thing to think about is, what are the things that companies need to be adaptive and to survive? And what industries offer those things to them? Well, in this digital revolution, there are unfortunately cyber criminals. They range from people trying to get your password so they can get into your email, your bank account, or organizations planting viruses on big online systems to demand ransom. So we need cybersecurity to help us create a secure cyber environment. And there are companies that do that. And then there's cloud computing and artificial intelligence. These days, people aren't storing their information in physical files, even on hard drives. They're storing their information on the cloud. And that gives a lot more storage space. And if it's done with a reliable partner, it's safer, it's more flexible. And then lastly, there's digital health. And in the course of their lifetime, the average American spends over $400,000 on their health care. But the rule of thumb is the older you get, the more you spend on your health care. Bhaskar mentioned longevity before. In America, for example, seniors spend 3 times as much on their health care as people in their 20s and 30s. The average American is getting older. People all over the world are getting older. The chart on the left shows the number of people age 60 and above is going to rise by 40% in the next 10 years. So we'll need more medicine. But medicine is also changing. Traditional medicine means focusing on treating diseases in big groups of people. Now there's a new field of medicine. Bhaskar mentioned biotechnology. A subset of that is called genomics, that's used to track individual people's genetic information in order to cure them. Messenger RNA technology, the kind used in the Pfizer and Moderna vaccines, is an example of that. As with all technology, the major hindrance is affordability. But look what happened in the chart on the right. The cost to generate a high-quality draft of a whole human genome sequence was about $5,000 in 2015. It's about $700 today. And this is a space we expect to have a similar growth profile to, say, the social media or the cloud 10 years ago. And it's going to revolutionize large segments of the healthcare industry. So to go back to messenger RNA and what Bhaskar said, its applications are phenomenal, potentially cures for the flu, the common flu, AIDS, cancer. They're really unlimited, and it's an investable space. So, ladies and gentlemen, to summarize, I'm bringing back the first slide that Bhaskar showed us of our 4 pillars. The world is vaccinating, opening up. There's going to be a strong economic recovery. Inflation is a hot topic, but we don't think it's going to last. And along those lines, technology, healthcare, value stocks, U.S. small caps, Chinese, Indian stocks, some Asian high-yield bonds are what we'd recommend. And then longer-term structural trends are the ones on the right, sustainable investing, identifying companies that are going to be the big winners in the digital revolution. And that means, as I said, things like sustainable food, future mobility, digital health, cybersecurity, cloud computing. Well, ladies and gentlemen, that's all we have time for today. And what we're going to do now is open it up for questions and answers. So back to you, Joe, please.
Thank you, Mark and Bhaskar, for that. Very interesting insights. We have had some questions coming in. So why don't we start with one sort of on inflation and tapering together? And you've touched on this a bit, but assuming that we're entering a scenario where perhaps tapering comes a bit sooner than expected, 2021 or 2022, where we'd expect it to take a bit more time, how would you react from a portfolio perspective? How should you position a strategy to deal with what could be a bit disruptive if this happens faster than expected?
You're the portfolio manager, Bhaskar. I'll leave that to you.
Okay. Though you answered it perfectly well yesterday, so I'm going to use those actually. Let's put it this way. We don't think if there is going to be a tapering, which is way ahead of what expectations are, I think it will be market disruptive. But there is very little reason to believe that will be the case because unlike in the past, the people who will hurt the most are the government themselves or the policy makers who will be making these. So the chances are that they're not going to be self-destructive, and hence the chances of a faster than expected tapering is less likely. That's one. The messaging globally is that from the same policymakers who have the capability to make this tapering happen is that inflation is transitory. They're completely okay with where it stands today, and they do think that it's going to hover around the 2% mark, give or take a few basis points above or below in the foreseeable future. This goes back to everything that we've discussed today in terms of right from the immediacy of the fiscal stimulus to supply constraints being removed to technology's impact on inflation. So it is true that should such a thing happen, should there be really more aggressive, I think there will be a big tactical shift in the asset allocation, preferring risk-free assets, things that are more defensive in the equity space, like dividend plays, higher quality, staples, things that generally tend to do much better in an environment like that, but not today.
Okay, thank you for that, Bhaskar. And here's one what's definitely particularly relevant for a country like Thailand. And this question concerns both from a Thai perspective, but also a global perspective. And perhaps this is a question more for you, Mark. When and how do we see tourism and world travel and the time before COVID coming back? What are your expectations for how quickly we'll see that and what it will look like?
I would just say that in the case of Thailand, for example, I'm very encouraged that, for example, Qatar Airways is accepting reservations for flights to Phuket in July. To me, the faster we vaccinate, the faster we open up. And I think that Asia, in a way, of course, was the winner last year of COVID because it effectively stopped the pandemic from entering its countries through sealing its borders. But in a way, it's the loser this year because there was a sense of comfort and we can take our time that is now kind of catching up to us. So I think we've realized that. We're accelerating the vaccinations in all of these countries now. And I therefore think that, that we will go back to even, dare I say, normal. It's hard to believe now, but I do think that with the vaccines, it will take COVID down to something like, for example, the measles or yellow fever. And you might remember, maybe not, Joe, because you're a little younger than us, but I remember when you had to, when I was a youngster, we had little certificates, vaccination passports for yellow fever and other things like that. Yes. As I recall, it was actually a yellow booklet. And you'd have to take that along with your passport to enter into most countries. So we're going to go back to that again, but that's not a big deal as long as you're vaccinated.
Thank you, Mark, for that. We have another question, and we've touched on this already in the questions as well as Bhaskar, you mentioned value and maybe perhaps barbelling an approach between keeping growth stocks, also having cyclicals and such. Nonetheless, people, of course, having seen the rotations that took place in the market, I think people are a little concerned. Maybe did you miss the boat? Is there still a chance? So the question here is it too late to get into value stocks here, particularly in the U.S.? I mean, I know you've highlighted healthcare as a great value play. Small caps could be. Sounds like the answer is no, but we have missed a bit of a run. How do you sort of feel about positioning in terms of thinking about whether we're too late? And the second part of the question is also on Europe, how we feel about Europe.
Let me take the first part, and Mark, maybe you could add to that and also comment on Europe. Just to look at growth versus value. Growth has been obviously the structural story for the last 10 years. And if you were to look at the kind of differential in performance this year, value is possibly somewhere in the high teens. Growth is possibly just getting up to the double digits. So there's a nice 8-9% difference between the two. But while it's significant from a year-to-date performance difference, if you take the longer-term trend, that's not the case. Now, if we were to look at the next 5 years, we still believe that growth as the hedge over everything else, right? So the first message that I want to provide everyone is you have to own growth. That's the first story. Now, two, I think value still has legs, so it's not too late to buy them. So I think you should still buy value. You could look at financials, you could look at value indices, you could look at various aspects, and so you could still buy into the value story even now. I just don't think they have the long legs of growth on a 5-year basis. But over the next between 4 and 6 quarters, I think value is just as good to own as growth.
So on the European question, I love kind of reciting Lee Kuan-yew quotations. And so I'm going to do that now because in 2011, he was asked about the European Union, and he's always been quite a blunt character. So he said it's not going to survive because they're too different. They have different languages, different cultures, different everything. And so I'm not going to say that it won't survive, but I will say because of that, it's a very slow bureaucracy. It's very difficult to get all 25 countries agreeing to everything. It took them ages to put together their fiscal stimulus package. And there are a lot of hawks in Europe on the monetary side, the Germans in particular, but the Dutch and a few other countries, they don't like the idea of giving money to their southern neighbors. So that's point number one, is it's slow and inefficient in the way it's run. Point number two is that the composition of their markets is very different from the United States in that only, I think the last time I looked, 6% of the European stock markets were technology companies. So when you're buying Europe, you're basically buying banks, number one, and then you're buying industrials, and then you're buying some other bits and pieces. Now, every country in the world has something that they are really good at. Thailand, I think, is really good at tourism, for example. Europeans are very good at luxury products, and nobody can beat them, in my humble opinion. So that's a good sector to invest in. But the others, why would you really want to go out of your way to buy a European industrial, European bank? Maybe for the recovery this year, because of course a bank or an industrial company are geared to recovery, and those banks and industrial companies in Germany and France are big multinationals. But longer term, I don't see why one would want to own them.
I just one little point. When you were talking about Europe and how they tend to hurt themselves more than anything else, what came to mind was BioNTech should have been a European solution.
It's a German company.
It's a German company.
So just to let the ladies and gentlemen know, they were the ones who figured out how to make the messenger RNA work in a COVID vaccine and partnered with Pfizer.
And yet they didn't capitalize on that.
They did an IPO in Germany.
Yeah, exactly.
Well, thank you for that. I think we have time maybe for one or two quick questions. We've heard China, India, in your views here on Asia. How do you think about an allocation to Asia? Is it time to really make sure that we own a core position in Asia, particularly our high conviction countries, going forward into the next decade? How do you think about positioning Asia? We always talk about the U.S. Investors are constantly talking about Western markets. How does Asia fit in?
Okay, I'll take that. I think the two countries that we've talked about today, both China and India, I think structural stories for the next decade. I think you got to own them. I think China becomes a core asset class in any asset allocation in the future. So 5 years from now, nobody who has a global asset allocation is going to do it without having China as a piece of it. So, and I still think it's very, very grossly underrepresented in most allocations. So I think China is going to be a clear winner in this both flow process as well as in the value discovery process, right? It's already shown that it can come up with great companies, global in scale, and very profitably run. So clearly there is a value proposition as far as China is concerned. And I think as various other arguments have been made, I think India is along the same path, maybe a little behind China, but it's going to go through the same process. So I think these two are absolute core holdings in this part of the world. The one other thing that we've always recommended or talked about in Asia is owning the real estate investment trusts which tend to be a core way of owning value plus income instruments in this part of the world.
Thank you for that, Bhaskar. And I think just looking at the clock here, we've run out of time. We would obviously encourage our clients to continue with follow-up questions. We're happy to engage and continue the conversation. With that, that ends the portion of our investment views shared by our esteemed partners in Julius Baer, Singapore, Bhaskar, and Mark. We greatly appreciate you taking the time to be with us here virtually today. We hope that next time we can do this together in Bangkok. Thank you very much for your time.
Thank you, ladies and gentlemen.
And ladies and gentlemen, that brings us to the investment solutions portion of our presentation today. And there's no shortage of solutions available on our platform. The platform has been purpose-built for you to have these solutions delivered to you here in Thailand, our true home. And we're leveraging on, of course, the global expertise and the global platform capabilities of Julius Baer. So when it comes to these long-term secular themes, these things that you hear about from Mark and Bhaskar, the technological revolutions we're seeing, digitization, artificial intelligence, movements in digital healthcare, we have solutions in all of these areas. And we've actually talked about some of these solutions at previous investment outlooks. Today, we're going to take a little bit of a different approach to talking about solutions and speak about a few new things. We're going to start with Asia, and then we're going to also speak about some shorter-term opportunities that you can take with your portfolio, as well as an alternative to fixed income in your fixed income portfolio, because it's important we don't ignore the fixed income part of your portfolio as well. But let's start with Asia. We believe that our discretionary mandate program, which is made available through our private fund license here in Thailand and accesses the world-class Julius Baer platform, is an excellent way to access Asia for a longer-term core holding in portfolios. So what we're showing here is a slide on our strength of bench. We have fundamental research and investment expertise. We have over 150 investment management specialists that serve the discretionary programs of Julius Baer that we make available to our clients here. Now, this is important. These are the individuals, similar to Bhaskar himself, the CIO in Asia, as well as the portfolio managers, the investors who invest capital on behalf of our clients. You give the discretion to invest in various programs and various strategies, and we run that capital. We take that obligation very seriously, and we have strong teams doing this. So looking at Asia, moving forward, not just in the short term, but the long term, we see tremendous opportunity. As you heard, China and India, in terms of earnings growth expectations year on year for both 2021 as well as going forward into 2022, we expect this to be very strong. We see that as well across some of the other major Asian economies as well, places like South Korea and Taiwan. But perhaps more compellingly, the long-term structural growth trends in Asia are key to having an allocation here in the long term. And you heard at the last question, Bhaskar answer this in terms of having a core allocation to Asia, particularly China, but Asia as well. And this is to play on these major themes that we see: a growing middle class, the digitization of the economy, increasing demand in healthcare. How can we do that? We would propose one of the mandates that we have on our shelf, investing in what we believe to be Asia's most promising companies. This is a high conviction portfolio of companies, and we are taking a bottom-up approach. We are using that strength of expertise and bench that I showed on that first slide from Julius Baer to construct a hand-picked portfolio concentrated in conviction trades, looking at leading firms in Asia, strong balance sheets, strong free cash flow generation, and sustainable business models. We believe this can form a component of a core allocation in investors' portfolios in order to take advantage of the opportunities that we see ahead in Asia. But you don't only have to take our word for it. If you look at the sample mandate that we're showing you here on the upper right-hand corner, we have returned over 12% per annum against a benchmark which has done about 10.5. We've done so with less volatility and lower maximum drawdowns. And this is made possible, of course, through the selection process of really picking what we believe to be best-in-class companies for this portfolio. Now, here are some slides as we move on to our next solution. Here are some slides that you saw presented during the earlier presentation with Mark and Bhaskar. both the vaccination rates in Western countries going up, as well as the confirmed cases in Western countries coming down. Now, we've talked a little bit about the combination of stimulus money in people's pockets, as well as the opening of economies. That can lead to a great deal of pent-up demand being released. And indeed, we saw in these charts earlier a huge spike in such things as retail and food services sales in places like the United States. Now, for our clients who are interested in playing this trend, but also understand that this is not a long-term, but rather a shorter-term pent-up demand trend, what we would suggest is accessing this through a structured note. And the note that we want to highlight today is a short tenor, 3-month note. Now, the benefit here is that you are participating in the entire upside of a laggard stock in a selection, for example, of rising consumption names. So you can choose names that will benefit from entertainment and consumption in the US. These names stand to benefit as the economy reopens and surges into the summer season. You can participate in 100% of the upside in these names, or indeed you can boost the note and participate in 200% of the upside. This is always of the laggard stock. At the same time, the minimum redemption feature protects your downside with a floor, so you are limited in the amount of capital that you can lose. But let's illustrate this for you in a bit of a graphic sense. If you were to purchase this stock outright, it would look like the dark blue dotted bar. You assume a 1% increase in the stock price equals a 1% return in your pocket. Likewise, if the stock goes down 1%, you'll lose 1%. That is that line that cuts straight across in the dark dotted blue. With a minimum redemption note, you're not giving up on the upside component there, either the upside equivalent to owning the stock on the left-hand side, or double the upside to owning the stock on the right-hand side, where you get 200% of the return of the stock. However, when you start to track negative on the downside to the left bottom portion of these graphs, what you find is, unlike owning the stock, if you held it outright where you have unlimited potential losses, the payoff for a note like this floors your losses at 95% or 90%. In other words, giving you a maximum 5 or 10% drawdown in this instance. What we look at are an example of 3 names with a 100% participation rate, and these are 3 actual names. You'll need to speak to your relationship manager or investment advisor to discover a bit more here. But if you were to put these names together, you could have more than a 95% floor, meaning you can't lose more than 5% on the stock price, and you get 100% of the upside of the laggard performing stock in this basket. If you were to take a 200% upside in a boosted note here, you do have to give something up somewhere, of course. So you get a 90% minimum redemption, in other words, up to 10% downside, but at the same time participate in 200% of the possible upside. So this is a way that we can access some of this surge in consumption spending seasonally that we will expect to see going into summer, but perhaps one of the best summers America has had for a very long time, as finally masks are coming off, people are going out, and they are spending money. Moving on to the small cap space. We saw this slide, Bhaskar showed it on the screen, and discussed why we think small caps make a lot of sense. Small caps are far more leveraged to the economic cycle than large cap companies. And you can see here over 3 times more leveraged to GDP growth than you would expect to see from large cap companies. Additionally, we expect strong GDP growth. And that's illustrated, and Bhaskar has mentioned that. In fact, the strongest GDP growth in decades, not since the early 1980s, has the US seen GDP growth like that we expect for 2021 in the United States. Yet, at the same time, small caps are undervalued relative to large caps. If you look at the average valuation differential between the Russell 2000 small cap index and the S&P 500, we are below average, meaning small caps remain undervalued. And this is despite what we believe to be the tremendous growth opportunity ahead. However, when buying small caps, we suggest selectivity. Simply buying the index outright might not be the best way. And we actually would recommend working with an active manager who selects stocks within the small cap universe in the US and has a strong track record in doing so. But before we come to that, let's talk about the size of the small cap market. This is quite interesting because every time you start to talk about this part of the investment universe, the very first word you hear is small. Well, it is. They are small compared to US large caps, but in fact, not that small compared to many parts of the world. So indeed, pale in comparison to the size of large caps in the US or an index like the Shanghai Composite in China. But it's worth bearing in mind that the size of the small cap market in the US is actually larger than a lot of the major world indices that we look at, including the FTSE 100 in the UK, France's CAC 40, the Taiwan TAIEX index, and many others. So whilst called small, this is by no means a small investment opportunity. But like I said, we want to make sure we're accessing it through the right solutioning tools. We believe that our fund in focus here, Fund A, and again, in order to get a bit more information about Fund A, including its name, please do speak to your investment advisor or relationship manager, and we're happy to share all the details and help understand whether this is a suitable investment for your portfolio. But Fund A, you can see, delivers a higher return on equity than the broader Russell 2000 index. That's the blue versus the gray bar. In fact, it's not so far behind the S&P 500 large cap companies when it comes to return on equity. Additionally, it has a lower debt to EBITDA level than the Russell 2000, and perhaps most notably is invested in a very small number of money-losing companies compared to if you bought the Russell 2000 index outright. What this means through careful stock selection and high-quality approach is that you have a better risk-return profile with a fund like this than you would have if you simply bought the Russell 2000 index. What you see here is both on a 3, 5, 10, and 20-year basis, we are exhibiting a much better risk return through this fund than through the Russell 2000. So what you're looking at here on the y-axis on the left-hand side are the average annual total returns of all of the various instruments, either the fund or the Russell 2000. But what you see on the x-axis is the standard deviation or the risk. In other words, the volatility, or what I like to refer to as the sleep well at night factor. How well you sleep at night depends very much on whether your stock prices whipsaw around. You're up at night watching your portfolio fall and rebound the next day. That is not a good feeling to have. You want to reduce that volatility in a portfolio, and you can do so through an investment like this. So the substantially lower volatility that we see here being closer to the left-hand side of the graph for our fund versus higher volatility on the right-hand side for the Russell 2000 means there is a distinct risk-return advantage in selectively choosing companies and working with the right active manager. We'd be happy to share more about this active manager with any of our clients who are interested. Moving on, there is concern around valuations, around tapering. It was one of the questions that we had just now, and indeed you saw this graph during the presentation from Mark and Bhaskar. The Federal Reserve balance sheet is massive. It has inflated tremendously since the global financial crisis, and of course we've seen stock prices trending up as well. So people are concerned if we are overheating. Even if we're in a bull market, will we see a temporary pullback from here? Well, indeed, if you look back at the recovery after the global financial crisis from 2009 onward, when markets began to recover, and you compare that to the COVID recovery crisis after markets bottomed in the earlier part of last year, we do see a possibility, if we follow the global financial crisis trend, that we may see a bit of a pullback here. Shown in a different way, if you look on average around bear markets and recoveries out of bear markets, the orange line is where we are now after the coronavirus crisis. The dark red line, again, is what you saw on the last page, the global financial crisis. But interestingly, if you look at the dark blue line, that's the average out of all bear markets. So depending on whether you're benchmarking this against the global financial crisis or the average of all bear markets, we could see various outcomes. We could see a pullback, or we could see sort of some sideways trading here. Nonetheless, in all of the scenarios, both the global financial crisis and the average, we do tend to see stock prices rise in the future. So we go back to positive even if we see a shorter term pullback. But it doesn't work to say eventually the stocks will go back up. We want to make sure we're protecting our portfolio at any given time. So for those investors who are concerned, who are thinking maybe we take a bit of profit off the table, we like technology, we've been invested in it for many years, for example, but we wouldn't mind shaving some profits, but not giving up our market exposure, we would propose using a twin-win structure. Now this is an interesting structure because it allows you to capitalize on movement either sideways or even a consolidation in the market. What this instrument will do is allow you to collect a coupon if ultimately the stock goes up above today's level, but likewise, it will give you the downside performance translated into positive return of the instruments that you select for this note. In other words, you can make 10, 15, 20% when a stock falls in positive returns. Now, there is, of course, a knockout barrier below which those returns no longer apply. So let's look at this graphically so that you can understand what this would look like. Let's take the first example. The stock ultimately trades up. If you were to invest in this instrument, and again, we're looking at the laggard security in the note or a single underlying in this instance. So if this company, we enter the note, it has a knock-in at 70% and a 12% coupon. It moves along in a sideways trading pattern and eventually breaks out. You collect 12% per annum coupon for the number of months that you hold this stock. In this case, 3 months, you would make an absolute return of 3 months, which is an annualized 12% return over the time period the structure was in place. Now let's look at the next scenario. We do get a bit of a pullback from here and stock markets fall. We start at an initial price level. Ultimately, the laggard stock falls 22% by the end of this note. You take that 22% performance and you translate that into a positive 22%. So you ultimately take 122% return back from this structure. You get your initial plus your 22% return, which is the downside of the laggard stock. It protects you in that scenario. Now, what if we hit the 70% knock-in level? In that case, you will receive physical delivery of the laggard share, and you will receive it at 100% of the original value, which means you do lose money. There is the risk to this structure, but the key point that I would make is that this is ultimately no different than if you bought the stock outright today at 100%. If you bought it today and you held it and it went down to this level, it would be the same result in your portfolio. So rather than holding the stock outright, you can benefit in this particular instance from a 30% window where you turn negative returns into positive returns. Beyond that 30%, it's as if you were holding the stock in the first place. So again, here's a bit of a summary of the way this could look. Either it could be called, could trade down, or could trade down and break through your barrier. You profit from the coupon if it trades up. You convert negative to positive performance if you remain within that trading band. And of course, you take physical delivery of the laggard at 100%, the same as if you were to own the stock outright in your portfolio today. Those are your three scenarios here. We think from a buffering and a portfolio hedging perspective, this can certainly make a lot of sense. So I want to move now to our final solution of the day. And here we're going to look at an alternative to fixed income, to traditional fixed income. You saw in Bhaskar's slide on asset returns, fixed income has not been a stellar performer this year. And indeed, we continue to expect rates over time to move up. You saw where the Treasury expectations are. We do expect movement upward from here. Asia high yield is one area that Bhaskar mentioned, and we have definite conviction, and we have some funds and solutions that can play that. But if you look overall at the high yield market, we'd like to also introduce an alternative that can provide some better dynamics to investors than you could get from simply owning high yield bonds. And it would work as a diversification tool to take some of your high yield bonds and diversify into this alternative asset class. And that asset class is private credit. And I'm going to explain sort of the origins of private credit and then the benefits in terms of the various components of it. In the United States, in the last 15 or so years, banks have participated less and less in loans to mid-sized companies, preferring instead to focus on mega large cap transactions. It's easier for them to make one big concentrated loan and all the fees that go with it than to make smaller, more complex loans to smaller companies. So what that has meant as a result is that bank lending has fallen, and you can see here it's fallen roughly in half in terms of the participation of banks in loans in the US. That has created an opportunity. And the opportunity is lending to the US middle market, who tend to be overlooked by banks. When we talk about the US middle market, we're talking about roughly 200,000 businesses. These are not small companies, these are just smaller companies. These are not mega cap, large cap companies. And in fact, if you took this component of the US economy and stripped it out from the rest of the US, it's the third largest in the world. It's a substantial component of the US economy. And it is healthy companies that we're talking about, but companies that struggle to get lending traditionally through traditional bank channels, given the secular trend away from bank lending that we have seen in the US. That has, of course, created the opportunity for private lenders. Markets are efficient. Where one party leaves, another party steps in. So we have seen private credit pick up as a percent of the total credit markets in the US. And in fact, that growth has been quite tremendous, from 8% now to 19%. So nearly 1/5 of the US credit market is met through private credit lending, the needs of companies in the US. 1/5 of those needs are being met through private lenders. What are some of the differences in private credit? I'd say first worth noting, and in fact this is related directly toward what we heard from Bhaskar earlier. When rates rise, bonds can suffer. Most bonds are fixed rate instruments. If rates rise, bonds end up pricing downward because you require a higher yield in the environment that we see today than the bonds that you hold. So we end up seeing ultimately that price decline in bonds. What we have in private credit is a floating rate benchmark. That floating rate benchmark means that as rates rise, so too do the loan price, so too do the loans themselves in terms of the coupons they pay. A coupon is paid over a floating rate benchmark. When interest rates rise, the coupon payment simply goes up. So you don't have that risk having floating rate instruments. An additional component is the security in terms of where you are in the capital stack. So we're talking about senior secured loans versus with recourse to collateral and covenants in place versus high yield bonds that typically are not secured and are lower on the capital stack. What that means ultimately is you can get better risk return dynamics from private credit. What exactly are those risk return dynamics? Well, the high yield market in the US yields on average 5.8%. The private credit market can yield higher at 8.8%. Yet, at the same time, we see far lower losses, average realized losses in the private credit market as compared to the high yield market. And this is precisely due to the reason that I mentioned earlier. When you have better protection, when you are senior secured, when you have access to collateral as recourse, in the event of a default, you recover far more of your capital. So the average loss rate on high yield bonds in the last 15 years has been 1.7% per annum and only 0.3% per annum for private credit. We offer a solution as an alternative to high yield bonds, and I'll go through a few of the components within this solution. The solution will target about a 7.5% annual yield net of fees, so certainly is more than adequate as a replacement from high yield bonds from an income perspective. It has monthly subscriptions available, monthly NAV, monthly distributions of capital for those who choose the distribution share class, and quarterly exit liquidity. There are some conditions and terms around that exit liquidity that you'll need to discuss in more detail. If you're interested in this solution, we're happy to have a follow-up conversation. This is a floating rate benchmark, as I mentioned, and has higher yield than bonds and lower loss rates than high yield bonds, given the fact that these are senior secured loans with strong collateral protection. As I mentioned before, there are still illiquidity risks as this is a less liquid asset class, so do have a conversation on the suitability of this particular solution to your portfolio. That concludes the solution section of our event today. We thank you very much for joining us here virtually. Before I go, what I would like to say, particularly because we haven't been able to be in the room together with you, is that this is not the end of the conversation. This is only the beginning. Please reach out, speak to your relationship manager or investment advisor. I imagine they will be reaching out to you as well. We hope to have conversations in more depth, more personalized to your needs as to how our investment views and the solutions that come along with them can best be incorporated into your portfolios. Remember, we are here to work beside you here in Thailand in the interest of your wealth and long-term needs. We'd like to thank all of you for taking the time to join us. Thank you for being an interactive audience and participating in the polling and the Q&A. Any further questions or further details that you would like from us, we are more than happy to provide those to you on an individualized basis. Please speak to your relationship manager or investment advisor to find out more. Thank you again for your time, and we hope to see you in person very soon. Thank you very much, and Sawadee Krap.